to my channel. To those of you who are new, welcome. This is the channel where we, dive into all things finance. I give you the information, you do what you want with it. Okay. And those of you who are returning, welcome back. It's good to have you back. And yeah, let's continue on this journey. Okay. Right, introductions. I don't know, I keep forgetting every time. My name is Viewemda and I am your financial wellness empress. Okay, right, let us continue. So in my previous video, I dived into I introduced the world of assets to you guys. We compared real and financial assets, and then we dived into financial assets, starting with investing in the money market. So now we're going to be talking about the bond market, right? So if you recall, in that previous video, I did tell you that there's generally four asset classes in the financial asset side of things. The first of which was cash or the money market. And now I'm going to be diving into the next one, which is bonds. So yeah, bonds, the bond market or the capital market as some people like to call it. Okay, right. So what is a bond? What is that? Okay, I'm gonna tell you. So a bond is it's a type of fixed income security. So it offers you, as the investor, a series of fixed interest payments during its lifetime, along with a lump sum payment at the end of its lifetime. Okay, so if you buy a bond, depending on the kind of bond it is, and we'll get into that, depending on the kind of bond it is, you'll get interest payments periodically, depending on what you agree on, and then for the duration of its life, and then when it matures, I'll get to the explanations. Then at the end of its life, then you get your lump sum back. Okay, so essentially, yeah, that's it. So it essentially acts as a formal loan agreement between you and the borrower. So much like the money market as well, right? So it's a loan agreement, and you give out money and you earn interest, whilst the borrower hasn't paid you your lump sum yet, and then when it ends, they pay you back your lump sum. Okay, so yeah, it's sort of works similarly to the money market, which I did explain. The only difference is that, not the only, but the most prominent difference is that the money market generally is for you lending for 1 to 12 months, so very, very short term. And with bonds, it's anything from a year up to 20 years, sometimes even longer. Okay, so it depends on the agreement itself. Remember, we're dealing with financial assets, okay? So it's mainly legal rights and obligations, of which I did explain that. Okay, yeah. Alrighty. So so essentially, in exchange for your money, the borrower promises to firstly pay you an interest at regular intervals. Okay, so obviously the intervals, or the how often you get that interest, will depend on your agreement with the borrower, and this interest is known in the bond world, or in the bond market, as coupon payments. That's right, coupon payments. So don't forget that term, because I will be mentioning it a lot. Okay, so other than that first promise, the borrower also promises to secondly repay you the original amount at the end of the term of the agreement. Okay, so this is known as the principal, right? And the date of which they pay you, or the date of which the end of the life of the bond is called the maturity date. Okay, so keep that terms in mind, because that's how I'm going to be referring to things going forward. Okay, so you've got coupon payments being the interest, and you've got your principal being the lump sum amount or the capital amount, and then you've got the maturity date being the end of the life of the bond. Okay, all right. Okay, so what are some of the key features of bonds? Okay, So firstly, you've got the issuer. Okay, so the issuer obviously is the entity or whatever corporation, essentially the entity that is borrowing the money. So they'll give out the bond in exchange for that money. And then you've got face value or par value. So this is the amount the bond is worth and also the amount you receive at maturity. Okay. So it's also your principal, depending on how you want to look at it. But essentially, yes, that is the face value or the par value. Okay. And then you've got the coupon rate. Okay. Not the coupon payment. Okay, so the coupon rate is the fixed interest rate paid to you as the investor. So it is the rate at which the rate on which your coupon payments are based or are calculated. Okay, yeah. Hence coupon rate, coupon payment. Right. But but anyway. Yeah, and then you've got maturity, so that is the lifespan of the bond. Okay, so bonds are generally can be short term, which is 1 to 3 years. They can be medium term, which is 4 to 10 years, and then they can be long term, which is 10 years and above. Okay, so yeah, essentially that is that's what I was telling you about with the difference. Well, the main or prominent difference between the money market and the bond market is generally the length of time that you borrow. You lend out the money to these entities. Okay, so yeah, I'm not gonna repeat myself on that. Okay, alrighty. So let's who are these people? These entities. Who are these issuers? Who are they? Okay, let me tell you. Right. So you've got public sector issuers, and then you've got private sector issuers. So let's start on the public sector side of things, right? So on the public sector, you've got the National Treasury, you've got state-owned entities. So state-owned entities would be companies like Eskom, Transnet, the Development Bank of Southern Africa, the Land Bank, and SANRAL. Okay, so yeah, these SOEs also tend to generally give out bonds whenever they're looking to finance themselves. And you've also got metropolitan municipalities. So it's not every municipality out there that can actually afford to give out bonds, because you've got to have the credit rating for it, right? So yeah, so there's only 3 that I know of here in South Africa that are that generally do tend to give out bonds, and that is the city of Johannesburg, yes, of course, naturally, the city of Cape Town, and the city of Tshwane and Ekurhuleni. So those are the 3. Yeah. Well, so the last one, yeah, they do generally, but it's not like an often thing, but they do it. Okay. So it's just a matter of you keeping an eye out, keeping an ear to the ground. But yeah, essentially, those are the public sector issuers. Now let's look at private sector, private and financial sector issuers. Okay. Okay. So you'll see why there's that distinction. Okay. So you've got the big 5 banks, right? The big 5 banks, and you're wondering, hey, but who are those? You're in South Africa, come on now. What are you doing? Sleeping all day? Living under a rock? But anyway, I'll tell you, right? So it's what? Standard Bank, Absa, Nedbank, FNB, and Investec. So yeah, the big 5 banks generally do also tend not to give out bonds whenever they want to get some extra money. Alrighty, yeah. And then you've also got your large corporations. So that's where that private comes in, right? So the big 5 banks fall into the financial aspect of things, and the large corporations or companies, businesses, you guys, will then fall into the private sector of things. Okay, alrighty, so who are these large corporations? Large corporations, so obviously we're talking about public entities here, you guys, companies that are listed in the JSE. So those would be MTN, Vodacom, ShopRite, yes. Yes, they do. Pick and Pay, Anglo American, Sasol, Growth Point, Redefine, Yeah, those are some examples of companies that I know generally tend to give out bonds whenever they're looking for financing. Okay, yeah. What is part of their financing activities? Okay, alrighty. So now, what are the type of bonds that are out there? Right, all right. Okay, so there's essentially four main types of bonds, right? So you've got firstly your coupon bonds or your vanilla bonds, as they like to call them. Don't ask me why they call them vanilla. I do not know. Yeah, it's just a term that existed before I was born. So anyway, okay. So these bonds are essentially the most common type of bond out there. They're very straightforward in that they offer you a fixed coupon rate, which stays the same essentially for the duration of the bond until maturity. Okay. So if the bond is for 10 years, then you'll be earning the same coupon payment, whether annually, quarterly, whatever the agreement is, you'll be earning that coupon payment for that 10 years. It's going to stay the same for that 10 years, and then you'll get your lump sum at maturity, being at the end of that 10 years. Okay, so that was an example. That was an example to sort of, give you an idea of what it is that I'm talking about. Alrighty, okay. Right, and then the second type would be your floating rate notes, okay, or FRNs as they like to call them, right? So this one is sort of like the opposite of the vanilla bonds, because this one does not, floating rate notes, the interest rate is not fixed, or the coupon rate is not fixed. It changes periodically, and the change is based on a benchmark, a market benchmark, and it could either be the repo rate or the JIBAR. The JIBAR, J-I-B-A-R, you guys. I'm sure this is the first time you're hearing all this and you're wondering, hey, well, what the hell is that? Okay, I'll tell you. Right. So this is a benchmark that's actually unique to South Africa. It's the meaning of it, or because JIBAR is an acronym, you guys. So it's actually the Johannesburg Interbank Average Exchange Rate. So hence the JIBAR, or the JIBAR. Okay. So it is the average rate at which local banks buy and sell money. Essentially, they lend to one another. So if FNB wants to lend to ABSA, they'll use the JIBAR rate to determine what interest the other needs to pay to the other. Okay. Making sense? Making sense? Right. Okay. So there's actually something interesting that's currently going on regarding the JIBAR. So South Africa is wanting to move away from that. I think they're actually trying to. They're actively doing that. I'm not quite sure. But yeah, they're trying to move away from the JIBAR because it's something that the banks set. Okay, so it sort of gives them a level of power that is sort of uncomfortable for the government, finally. I mean, okay, so so the JIBAR actually, it's something that affects quite a number of things in South Africa actually rely on this rate, okay? And this is one of the things, this floating rate note. So the South Africa is looking to move away from that. What they'll move to from the JIBAR is the Zaronia. I wonder who comes up with these names. But anyway, the Zaronia is actually the South African Rand overnight index average. So essentially the difference will be that instead of the banks being the ones to set the rate, they'll actually look at, it's going to be based on daily transactions, okay? So they're going to look at real information and then determine the rate based on that, instead of, the banks deciding, let's make it this, yeah, let's make it this, let's make it this. But anyway, yeah, essentially that's what they're planning on doing. Yeah, I mean, research your own research and decide for yourself whether or not it's a good thing or a bad thing. Alrighty, okay. So yeah, floating rate notes, they don't offer you a fixed interest rate. It fluctuates, okay, depending on market movements. Okay. So, and then you've got your zero coupon bonds. I mean, this one is quite obvious. Zero coupon. Come on, guys. Come on now. Okay, but it's fine. It's fine. I'll explain it. I'll explain it. So your zero coupon bonds, essentially, these do not pay you an interest, okay? So zero coupon. You're earning 0% interest on those bonds. But the benefit, right, is that because there are no coupon payments, instead you buy them at a deep discount, okay? So, and then you receive the full price at maturity. So if, for example, the price of the bond when you're buying it is 1,000 Rand, the full price is 1,000 Rand. If it's a zero coupon rate, you likely buy it for maybe 800 or 700, essentially at a discount, and then at maturity you get the full 1,000. Okay, so yeah, essentially it's sort of like your way of deferring having to receive interest until the end or until maturity. Okay, so obviously, and then the next rate, the next bond or type of bond is an inflation-linked bond, right? So, come on, it's in the name, you guys. Okay, you know what? I'm done, I promise. Okay, so inflation-linked bonds, the principal and coupon payments are adjusted based on the inflation rate to essentially protect your buying power as the investor, okay? So it's not just the interest or the coupon payments that are adjusted, it's the principal as well. So yeah, think about that and what it means for you. Okay, so yeah, I've gone over the 4 types. I'll give the information but not the advice, okay? Okay, sorry, that was just an inside joke. Okay, I'm done, I promise. Okay, yeah, okay. So, composure. Okay, yeah, we're back, we're in it. I'm here. Okay, alrighty. So, what are some of the special features or hidden rules? Hidden rules when it comes to bonds. So these are some terms that you'll likely need to keep an eye out on, you know, as you are making those agreements or as you are signing those agreements, okay? So the first thing you want to keep an eye on is the term secured bonds, okay? So I repeat, the term secured bonds, okay? What does it mean? So it essentially means that the bonds are backed by specific collateral, okay? To say that if the borrower defaults, or then you have a claim on the asset listed as collateral, okay? So that would be a secured bond. Next, another term you need to look out for is unsecured bonds, or these are debentures, okay? Unsecured bonds are also called debentures, you guys, okay? So essentially, debentures are no collateral, there's no collateral or security, okay? And essentially, you're going on, you know, the faith that this issuer is going to stick to their terms. Yeah, no security, nothing but their word. Alrighty, yeah, okay. So obviously, debentures, you know where they come from. They come from companies. Yeah, most corporate bonds are unsecured, okay? And then another term you're gonna have to look out for is senior debt, okay? I repeat, another term you're gonna have to look out for is senior debt, okay? What does that mean? So it essentially means that bondholders who have senior debts are paid first during bankruptcy. So if the issuer goes bankrupt, if you've got a bond and it's a senior debt, then you will be settled first. if yeah, during that whole liquidation process. And then you've got another term would be subordinated or junior debt. Okay, subordinated debt or junior debt. It's one and the same thing. Okay, so essentially it's the opposite of senior debt. These bondholders who have subordinated debt essentially are paid after senior bondholders are settled during liquidation or in the event of bankruptcy. Okay, but what tends to be a good thing, or what makes these subordinated debt type of bonds, is that they carry a higher coupon rate. Okay, yeah. So yeah, those senior debt holders, everything is a trade-off, you guys. You trade it off, a higher coupon rate for that seniority. Seniority. No. Oh, okay. I'm trying to be serious, okay? I'm trying to be serious. Okay, yes. Yeah. Okay, so like I said, everything is a trade-off. If you secure those bonds, you traded something off for that security, okay? So yeah, with financial assets or financial instruments, just always be on the lookout for that, Every good thing comes with its downsides, and every bad thing comes with its upsides, okay? Yeah, you just gotta know what and decide for yourself whether or not it is an acceptable risk or it is not an acceptable risk. Okay. Alrighty. Next, another thing is the term callable bonds. Okay, I repeat, the term callable bonds. What does that mean? Can I call those bonds? No, I'm just kidding, you guys. So it's essentially callable bonds. It says the issuer has the right to call back the bonds to early if, let's say, interest rates drop, allowing them to refinance cheaper, essentially. So the issuer, all right, the person who gave you those bonds, who you gave the money to, can say, hey, give me my bonds back, because now the interest rates are better, because maybe they want to refinance for cheaper. Okay, yeah, essentially that's it. And then the next thing you need to know is putable bonds. Okay, putable bonds. Okay. Right, so what does that mean? So it essentially means that the investor has the right to force the issuer to pay the bond back early if, for example, they need their cash back early for some, unforeseen circumstance or whatever reason. It's your money at the end of the day. But essentially, yes. So under putable bonds, you as the investor will have the right to say, hey, listen, take your bonds back, give me my money. Essentially, whereas with callable bonds, it's the opposite. The issuer is the one who'll say, hey, me, here's your money, give me my bonds back. Okay? Yeah, I hope that difference is making sense to you guys, all right? And then another term you'll have to be on the lookout for is convertible bonds. Convertible bonds, okay? So what are convertible bonds? What does this mean now, right? So convertible bond is essentially an option that allows the investor to turn the bonds into shares at a later date. It could be at maturity, could be whenever, depending on the agreement that you guys have, right? So these are convertible bonds are usually issued by companies, and they usually come in the form of, that's right, debentures. Good. Like to know you've been paying attention. Okay, alrighty. The last thing you'll have to be on the lookout for, and I was actually quite surprised by this, because what in the world? But anyway, is the term green bonds. Yeah, apparently that's a thing, you guys. So green bonds is a type of bond where the money raised is legally earmarked for environmental or climate projects. Yeah, I think that was self-explanatory. I'm not going to explain it to you. Okay, so yeah, what are some of the risks that you need to consider when it comes to investing in the bond market? First, you've got the interest rate risk. I already explained what interest rate risk is. What I'm going to do now is explain to you how it applies to the bond market, okay? So obviously in the bond market, when interest rates rise, existing bond prices fall. Okay? And new bonds are issued with higher yields because there's a higher interest rate. Okay. Alrighty. So the bond that you already have, it suddenly becomes undesirable. Okay. Yeah, essentially, that is a risk that bonds face. Another risk is, yeah, this is actually going back to the interest rate risk side of things. So this is why some longer term bonds, tend to be less attractive than short term ones. Because imagine, especially if it's a fixed coupon, if it's a vanilla type of bond, right? Imagine receiving the same interest for 30 years, and we all know that interest rates are not going to stay the same for 30 years, right? They fluctuate, and we all know this. So yeah, so that's why some of these longer term bonds are undesirable, but they do come with a measure of security because, I mean, what if interest rates drop? So it could be good, it could be bad, but obviously in the long term, hey, yeah, so an example of these longer term bonds that are really sensitive to this interest rate risk is the R2048. Okay, yeah, get on your phone and do some research. Don't look at me with that questioning face. What's an R2048? Do I need to tell you everything? Anyway, then the next risk is, and this one is obvious, you guys, I speak about it all the time, it's the inflation risk. Okay, so by now, if you've been watching my videos, you know what inflation risk is. If you don't know, then what have you been doing? You haven't been listening. Okay. Oh my god, there's this a lady that I know who's always telling us listening is a skill. I did not understand what she meant, but honestly, I'm starting to. But anyway, yeah, inflation risk. So inflation risk essentially is the danger that the cost of living rises faster than your coupon payments, which essentially erodes your real return. Those terms from my previous videos are coming back. Eh? Yeah, so you want to know what real return is? Go watch my risk versus return video. You want to know what inflation risk is? Go watch the same video. You want to know what these risks are? Go watch that video. I mean, inflation risk, I've been saying it since I started, simple compound versus simple interest? Yeah, so yeah, that one you should know by now. Alrighty, listening is a skill, you guys. Listening is a skill. Alright, number 3. So there's also the credit or default risk. So this is the risk that the issuer may not be able to continue paying you the interest or repay you your principal at maturity. Yeah, so yeah, just like with every loan you give out, you guys, you're taking the risk that this person might not be able to actually pay you back the money or the interest as well. Okay, so there's that risk. And then you've also got your liquidity risk, right? So liquidity risk, I did explain what it is. So corporate bonds are harder to exit during market stress because they often have lower trading volumes on the Johannesburg Stock Exchange. Okay, so yeah, essentially, if you've got a corporate bond, it might be a bit of a challenge for you to exit the bond, especially when markets are not so great, because nobody will want to buy that bond. Okay. But if you've got a debenture that is convertible, then don't mind me. Yeah, so government bonds are highly liquid on the Johannesburg Stock Exchange. But here's a little tidbit for you. Okay, don't shoot the messenger. I'm just a messenger. Okay, so South African government bonds currently have a sub-investment or a junk status. So they trash, you guys. The giant status in the global markets, indicating a speculative element regarding long-term repayment. I wonder whose fault is that? Anyway. Yeah, that's all you needed to know about bonds and investing in the bond market. So obviously, if you're someone who's looking to invest directly in the bond market, those are some of the most important things that you'll need to know. So obviously, you're going to need a financial planner, someone who's going to be able to calculate for you whether or not it is worth you investing in that bond. They'll calculate the yields that you'll get over the life term, the lifespan of the bond, and put it for you in real terms, so that you can actually, see, well, okay, will I actually be making money here, or will I be making a loss? Because not all that glitters is gold. Okay, and they'll be able to also actually look at the bond agreement. Keep an eye out for some of these hidden terms or rules that I mentioned for you, so that they give you a full explanation, determine and give you a recommendation on whether or not it's worth it. Okay, and then you'll just make a decision based on for yourself, because you know what kind of investor you are. Okay, if you don't know, then you need to figure that out, and if you need help figuring that out, watch my video on risk and return. Okay, alrighty. And then obviously, remember, just like in the money market, these issuers are not looking for 10,000 or 20,000 or 50,000. No, honey, they're looking for millions. Okay, so if you're someone who cannot invest in the primary bond market, which is directly, then you can invest in the secondary bond market, and that's through a middleman, essentially. So much like how I explained previously in my investing in the money market video, they are investment firms that essentially pull money from all of these different investors, and then they invest that money as a collective, and by that point, obviously, it's millions, which they can then invest in the bond market on your behalf. Okay, so yeah, and then you get your proportionate return. Okay, so yeah, you can do that as well, which is why if you're someone who has invested or is thinking about investing, if you're looking at some of these fine fact sheets or the different types of investment funds that are out there, you'll see some that are excuse me, you'll see money market funds, you'll see bond or income funds. So yeah, essentially those are ones that invest exclusively in the bond market or the money market. So yeah, it's just about you knowing what kind of investor you are and what you're looking for, what kind of interest you're looking for, and what do you want? You gotta know what you want. Okay. Yeah, essentially. Alrighty, so tax implications. Okay, so I mean, just like the money market, I know, I'm sorry you guys, I did not explain the tax implications in the previous video, investing in the money market, but do not worry, fret not. We're gonna do it now, and it's actually quite similar. It's one and the same thing, okay? Alrighty, so essentially, in the money market as well as the bond market, what you earn is interest, and interest is included as part of your gross income. So yeah, that's it. So it'll increase your gross income for whatever year of tax, for whatever tax year you receive that coupon payment, and then yeah, they'll determine which tax bracket you fall under and take the percentage. So if you're investing directly in the primary market, you might want to consider the tax consequences of that, because those coupon payments are gonna be high. Okay. But if you're gonna be investing, through a middleman, then obviously you're gonna have an investment vehicle, and depending on the kind of vehicle you use, you can defer. Right? You can defer that tax to say, I haven't withdrawn my money, so you cannot tax me. No. Okay. But obviously once you do decide to withdraw it, then they'll they'll tax you on only the money that you've withdrawn, okay, and only the interest, okay. Alrighty. But yeah, but we'll get to that, you guys. You know, we'll get to these investment vehicles. Don't worry, I got you, I got you. Okay, so yeah, for now, I just need you guys to understand the asset classes so that when I do actually talk about these investment vehicles, I'm now referring, when I say bond, you know what a bond is. When I say cash, you know what cash is. When I say property, you know what property is. When I say equities, you know and you understand exactly what I'm talking about, okay? Alrighty, okay, yeah. Progression, okay? That's how we learn, okay? Enough, okay, alrighty. Alrighty, so yeah, this has been it. Thank you for watching, and yeah, don't forget to like, share, subscribe, do the things, share this video. Somebody else might actually find it educational, educational, and who knows, they'll likely make an informed decision and grow their money, okay? Alrighty, you guys, mwah. The love is there always. Bye.